Good morning. Good morning, everyone, and welcome to another of MEREDA's morning menus. My name is Craig Young. I am a partner at the Bowlers Company. I am also a board member of MEREDA and co-chair the event committee. So welcome, everyone. This morning's topic is commercial lending today, how commercial lending, appraisals, and being a landlord has changed amongst the COVID-19 crisis. Sure to be an interesting conversation. Before I introduce our panelists, let me start by thanking our event sponsor, Norway Savings Bank. It is through the generosity of Norway Savings Bank that we're able to offer today's event for free and a series of morning breakfasts through the end of June that'll be free. If you want to check out the MEREDA website for details and dates, that'd be great. And I'm sure that Shelley will be sending out an email to that effect as well. Also, if you have questions today for our panelists, you'll see in the lower right-hand box of your screen, there's an opportunity to write in a question. We love to get questions from the audience. I'll try to take some throughout the event, but surely in the last 10 or 15 minutes, we'll take questions from the audience. So without further ado, let me introduce our distinguished panelists. Let me start first and foremost with Travis Fournier. Hey, Trav. Trav is the principal and owner of Main Street Capital. Next, we have Paul Collins. Paul is the Vice President and Business Development Officer at Granite State Development Corp. Welcome, Paul. Next is David Harrigan. David is the President of Mainland Consultant. Hi, David. And last and certainly not least is Tom Watson. Tom is the owner and CEO of Port Property Management. So welcome all. Tom, we're going to start with you, since you are the landlord in the room, so to speak. As I know, you own a number of different property types, some office, retail, there's some restaurants in that mix, and a bunch of different apartments. I know you're also a family man and have some children of your own. Tell us from your perspective as a landlord, how's it been the past 8 weeks or so since COVID really hit in sort of mid-March or so? What's it been like handling not just your tenants, so I'm sure there's a variety of issues there, but also just your bankers and your vendors in the day-to-day life as a landlord?
Well, it's been interesting, Craig. Thank you for allowing me the opportunity to tell my story. So we have 3 construction projects going on. One was closed down for 2 weeks because for a couple of reasons. Tenants were there. We were intermingling with tenants, so we had to figure out how do we separate that. So that was a little harrowing, shutting that down for 2 weeks. We've got another project in Biddeford. We had a young man that came down with COVID, so we had to shut that down for a little bit. I've got 50 employees, probably 2,000 tenants. I would say, and I would say the 2 things that we've found in our business is that there's 2 things. We have been constantly communicating with tenants, with employees, with vendors, with everybody, constantly. And the other piece is that every day it seems to change. That whatever communication you're putting in place today, you might alter it the next day. So I would say sort of that constant uncertainty is behind the communication. It's just constant. In terms of working with tenants, happily, the tenants are paying their rent. So our portfolio is about 90% residential. It's about 3% office and 7% retail restaurant. So the residential piece is, people are paying the rent. For those who can't or are struggling, we're working on payment plans, and that's really a small part of the residential portfolio, maybe 4%. We're working on payment plans. But what's really great about it is that we're working with our tenants and they're working with us. The office people are paying their rent. They like their offices, obviously, or apparently. The retail and restaurant folks, a little more difficult. And we can all sympathize with them. I mean, they absolutely had to shut down the business. So what we've done with our restaurant people, they understand we still got to pay our real estate taxes. We still got to pay our mortgage. We still got to pay for the lights. So we're asking them to pay between 60 and 100% of their rent. And whatever they don't pay, we're going to leave on the ledger. It's not forbearance, or it's forbearance, it's not forgiveness. And so we'll leave that on the ledger. So if you're going to pay me 60% today, we're going to leave 40% on the ledger. And we're just going to keep doing that. Again, we're uncertain for how long, but that's what we've been working through, and the tenant's been working with us, and it's working. So
I think the best part of this, you're saying it's working.
It's working. And I should, just a shout out, if you have a company of 50 people like I do, it's a really good thing to have a great chief operating officer. And I do. Our COO, Jen Monroe, has been the person who has been incredibly fantastic at communicating to staff and tenants and vendors. So shout out to Jen.
No, that sounds great. So obviously today's topic is commercial lending. Tom, have you been able to purchase any properties during this time frame or refi any properties during this time frame?
Oh my, it's been, we've been quite busy at it, as a matter of fact. I could go on and on, Craig. So you'll tell me, like, just raise your hand and I'll stop. But oh yeah, we've been doing substantial refinancing. We were about to close on a property June 11th. So refinancing has been quite smooth, in large part because we've owned the properties for some time. We've been operators for 26 years. The loan to values are 60% lower, and obviously the rates, all the indices dropped dramatically, right? I mean, you had the 10-year Treasury at one point, I don't know, was sub 0.5. LIBOR dropped tremendously, as did the swap index. So we were able to take advantage of that with our banking partners and get some really great rates. This is on the refinancing. Most of the money, and we do pull out additional funds. Most of that goes back into the properties. As you know, we own a lot of sort of older properties in the city of Portland that sort of demand that you plow money back into them. So a lot of the refinancing, the cash that you would otherwise pull out, is going back into the properties. The financing is trickier, right? So I would say financing is about buying a new property, and we've done two. Well, we're doing one June 11th. It's just a small 12 unit in the West End, and Trav can speak to this, but it's been a little bit difficult getting people to do new business. Again, I think Trav can speak to that. And I did want to do another shout out because NBT Bank, Jeremy Deering and Kim Twitchell, really stuck. We're doing a historic tax credit deal in Biddeford. It's going to be fabulous when we're done, but right now it doesn't look fabulous. And they stuck with us, and we went beyond the commitment date to get this deal done because of our federal tax credit investor. We went well beyond the commitment date. They could have bailed on us by right. They did not. They stuck with us. It was fantastic. I mean, it was like a video love fest or an email love fest when we finished it. So shout out to the folks at NBT on that one. And Trav can tell you more about that as well. Thanks for asking, Craig.
Well, I'm sure Kim appreciates the shout out, and that's a great segment lead into Travers. So Travers, this is where you step in, since you do a lot of Tom's work, and I know you work with a number of other folks as well. Tell us from your perspective, as easy as Tom says the financing has gone, I'm sure from your perspective, there's been a lot more going on. So why don't you tell us a little bit about what you do, and then maybe how business was pre-COVID, and then when you saw things changing, I'm assuming in mid-March or so, and kind of where you're at today.
Yeah, sure. No, thanks a lot, Craig. Appreciate it. So just a real quick snapshot of what we do. So clients hire us to help optimize their economics on a deal, the short, long-term goals that they have, the deal structuring, et cetera. We help financially engineer the project, from a capital stack standpoint, and go out and shop lenders and really just try and find someone that's a good fit and a good partner for the deal on the lending side. We work closely with appraisers and attorneys and make sure we get to the closing table in an efficient, effective manner. Prior to COVID, I would say that the lending climate was very aggressive and competitive. It was we'd send out we typically canvass a lot of lenders to find a small pool that really are going to be a good fit for it. We don't like to shotgun the deal up to dozens of lenders. We really kind of, select maybe 4 or 5 lenders at the end of the day after phone calls and interviews. And typically we get 4 or 5 really competitive term sheets back. Now that process it's taking longer to get term sheets back, partly because of PPP loan process and just how incredibly busy the lenders have been. And also, they're dealing with all of their clients, and some of their business operators are needing some assistance. And so they've just had a huge weight on their shoulders with deal flow. But we are getting some term sheets back, but we're not getting the 4 to 5 now. So now we're having to broaden that net, a little bit, a little deeper into the market. We're having to do deals with new lenders, and broaden our relationships further. The whole process really going through underwriting has changed dramatically. I mean, during underwriting, the lenders, either every week or every other week will ask, so how are the collections this month? So what about now? What about now? And so their credit department is very, very sensitive to how COVID's impacted the tenant base, and how is that translating into collections. So, and rightfully so. Fortunately, we've had on the residential side, and Tom can speak to this, but the collections have been very strong, and so on other product types it may be a little bit more challenging. But so I guess the quick summation is, we're having to work harder with the underwriting process, work harder finding that lender that's meeting our goals and objectives. And we're working really closely with the appraisers. Dave can speak to how hard it is for their role. They need a lot more information today as well, and it's just everything's taking longer, and it's a lot of work. But we're definitely successfully getting a lot done, and we're finding the right product at the end of the day. So.
And Travis, are you noticing any difference between the types of banks, whether it's a smaller bank, a regional bank, one of the larger banks? I know you also deal with like Fannie Mae and Freddie Mac and HUD, and we're going to get to SBA in a moment. Any difference amongst the style of bank, or is everyone just a little slower and a little busier and all of that?
Well, I would say that it really is all over the board, and like Tom said, it's changing. Banks are working really hard to try and figure out how best to position themselves in this new economy and new challenges that they're facing. But with like the smaller, I'm finding that lately the smaller banks have been a little bit more flexible, with a good relationship and good strength in your borrower. I'm finding that the smaller banks are a little bit more flexible. The larger banks seem to pull back a little quicker than everybody, and a little harder. And maybe it has to do with, they have a wider reach. So, maybe they're being impacted in other areas like other cities or other product types. So there may be a little bit more of an impact for them. But the smaller lenders, banks and credit unions, seem to be, a little bit more flexible at this point. HUD, Fannie, Freddie, they're still very active and viable option, great rates, good structures, but they're being a little bit more hesitant as well with stuff, underwriting a little deeper and collecting reserves, so debt service reserves. So maybe 6 months or 12 months of payments, putting that in a reserve till kind of we see a good track record, after a year or two.
Interesting. So let's move on to SBA. Paul, you're at Granite State. You folks do a lot of SBA loans. Tell us a little bit about what you do, why an SBA loan is different than conventional, say, bank financing, and what changes and challenges you folks have seen in the SBA loan pool from, say, mid-March till today.
Sure. Thanks, Craig. So what I do is I administer the SBA 504 loan program. It's a loan program that is a bank participation program. So we work with all the banks and credit unions and it is used to finance owner-occupied properties. So it's not for apartments, not for investment properties. It's for, manufacturing to buy a building or to buy equipment, that type of thing. The reason why people use the program is because it is up to 90% financing, which regardless of how hard Trav tries, most banks will only go like 80, 85. So,
and he's trying. He's trying.
Yes, I know. He's working hard for his customer. But it's a bank participation program, and the way that it works is the bank does the first 50%, and then there's a 40% behind the bank. So the bank likes it because they're sitting out there at 50% loan to value. The borrower likes it because they're only putting 10% in, and the borrower also likes it because the SBA portion is fixed for equipment 10 years. For real estate, it's fixed for 20 or 25 years, and it's fixed at a below market rate because, like Tom said, all those rates have kind of gone down over the last 6-8 months. The 25-year rate right now is under 3% in my world, which is just unheard of. So, I mean, Trav definitely works hard for his customer, but most of the time you can't get more than a 5, 7, or 10 year with the banks.
Interesting.
I'm going to have to talk to Trav.
I think Tom wants to see some of those rates as well. And Paul, how have you seen deal flow change from, again, say February to now we're into May? Are there less deals? Are there less banks that you're able to underwrite behind? How has that changed?
Yeah, that's a great question. So going into March, we had a great pipeline. It was one of the best we've had as a company. We cover Vermont, New Hampshire, Massachusetts, and Maine. I just cover Maine, but we do have people in all those states. And we had a great pipeline coming in, and then COVID hit. Everybody kind of panicked. And then all the bankers just worked on PPP loans for, 2-3 weeks, and all other deals dried up. We're coming back to the norm now, which is great. Hopefully we'll start picking up the way we left off in a couple more months. But there's still improvement to be made for sure.
Interesting. Well, we'll come back to some rates and terms in a moment, but let's move on to David and appraisals. So as we know, none of these deals are getting done without generally an appraisal. Maybe you can get a refi done once in a while, but generally all of our deals need an appraiser. So David, you're key to all this. Tell us a little bit about what you do, what Mainland is. I know you folks all too well, and how you've seen your work change a bit amongst all this turmoil.
The changes that are probably evident to the participants is our inspection process has been rolled back quite a bit. The banks and lending institutions have allowed us to use third-party sources to evaluate the real estate. So we're not walking around large multifamily complexes or buildings inspecting every unit. We're gaining videos, photographic evidence, and doing partial inspections of the real estate to learn more about the physical plant. So that's one that's very evident in the market that Tom and Travis and Paul know about and see us doing. As far as the appraisal process, the appraisal industry is governed by USPAP, which is the acronym for the Uniform Standards of Professional Appraisal Practice. And it does not allow us to just ignore an event such as this pandemic. We have to deal with it in some way, shape, or form. Acknowledgement and either some type of qualitative or quantitative analysis of what's taking place, and then apply that in the appraisal process. So bottom line, it's impacting values to some extent. I wouldn't say significantly at this point.
So let's dive into that a little bit, because I know as an appraiser, you're looking at sales from the past, whether it's 3 months ago or a year ago, to derive a value for today. And obviously COVID hit quicker than any of us could have really have imagined. Unemployment skyrocketed. Obviously, a lot of economic issues out there. How are you, I guess, encompassing that into your appraisals on today's value? Again, we can look at what Tom said earlier. He had an appraisal done on a property. They were refining, and somewhat of an arbitrary number was added to it. How is that coming into play?
Let's see. Well, you have different market segmentation. So the investment market, whether it's office, multifamily, retail, certainly has been affected. The owner-user properties to a lesser extent. So when it comes down to the investment market, we're absent sales data that's been impacted. It's too early. And the appraisal process is a lot about data points when it comes to sales. But from the income approach, when we take that and we apply it, we're looking at the pandemic from a more shorter term perspective. So I think one of the markets that's been impacted the most is the small retail. Tom has some of those users in some of his buildings, and he acknowledges that he's had to work with some of those tenants. So the appraisal is actually doing somewhat the same thing. We're recognizing that the small retail tenant that can't pay the rent, at least for a temporary time, is going to have an impact on the bottom line. So we're going about our capitalization process in the income approach the same way we did prior to the COVID. And now when we get to the final value, we pause and say, well, you're not going to be able to collect all that money over the next 3-6 months. And you make your best estimate as to how that plays out. So if you have a couple of retail tenants and they're only paying 50% of their going rate, you apply that to 4 or 5 months and you get a number. And that number is then deducted from what we've capitalized. So $1 million property, we do a deduct. As of the date of value, it just dropped down to, let's say, $980. Something like that. That's a quantitative way to go about the income approach. And then the other is a qualitative analysis where, when we do our analysis, we'll get a range of indicators. So if you don't feel comfortable applying a number, you can just kind of say, all right, well, I have a range of indicators from 950 to $1 million. And in light of the pandemic, I'm going to be on the lower end of the spectrum and be at 950. It's not scientific, but it's logical in light of everything that's taking place. And it's trying to echo the same process of deducting the monetary numbers because a tenant can't pay rent. So those are kind of the applications that we're applying.
And David, are you still primarily working for the banks and hence the buyers, or are there any cases where you're now starting to work for sort of partnerships or other groups or individuals out there?
That's interesting. I had an order this week from someone that wants their asset appraised because the timing would favor them because of probably the more conservative number that will come out of the process.
Interesting. Well, Tom, let's move on a little bit. Maybe we can get sort of a hands-on deal here. Let's see how this goes. You've mentioned you've acquired a couple of properties or in the process of acquiring a property, and that's a little harder than a refi. Can you and Travis walk us through what that looks like? And if you can, maybe even mention the property. I don't know that we want to mention any specific banks, but if you could sort of walk us through something you're acquiring, you call Traverse. Let's go over that conversation and how that's a little different today from how you're going to capitalize it. What do your partners think about it? What do you two think about it? Walk us through that.
Well, first of all, I really like Paul's 90%, Travis. We need to think about that.
Oh boy. Yeah.
So we've done a couple of Trav is more than a hired gun. For me and my partners, Travers is very much a teammate. We probably talk 3 times a day, all the time, about refinancing, financing, new deals. So there's sort of this constant back and forth. Is it time to refinance? Is it not? For example, I might have a note due 3 years hence, and there's a prepayment penalty on it. So, in fact, we just did this with the Lafayette, with Eastern Bank, who's now a new partner of ours, and really enjoyed working with them. And they were troopers through this COVID experience. But we looked at it. We said, okay, look, the note is due 3 years hence. There's a pretty substantial prepayment penalty, but rates are, and I'm sincere, rates were sub 2.5. I mean, unheard of. So you're saying, okay, I've got a sub 2.5 rate that I could lock in for 10 years. In light of that, the prepayment penalty became a minor hurdle. So that's sort of a refinancing that we've walked through. And Trav, just if you want to jump in at any point, because you go through much, you do all the work. I just sign the papers as they come along, for the record. And I would go back to the two. We have 3 projects that we are in the middle of. The one was the one we did with NBT, which is a tax credit deal. It was a fair amount of work, but they stayed committed. Trav, you can speak to that if you like. We're doing a small 12 unit in the West End, and I think Trav brought up that, where before we would get several term sheets, we probably got 2 or 3, and they weren't as friendly as they normally were. So apparently banks are a little.
Let's stop with that 12 unit for a moment. I think that's a great example. I think that a lot of people can relate to. The Benefit Project, I know, and it's great, but it's complicated. You've got tax credits and construction, and that's a bit convoluted for a lot of us. The 12 unit is not. And maybe, Travers, you can walk us through, what does that financing look like today? How many banks are you going out to? Is a rate really driving the deal today? Because rates are so low. I'm guessing the rate isn't driving the deal as much as all the other terms, requirements, and whatnot. But lead us through what that 12 unit looks like.
Yeah, no, it's a great question. So there's a lot of variables that we're always weighing. I mean, rate is obviously an important factor. Amortizations are a really important factor. Recourse, loan to value. So I mean, and also the relationship. Like, we want to work with certain types of lenders that are going to work with us and be flexible, and prepayment penalties that we can live with, et cetera. So there's a lot of components that are all important at different levels. On that deal, I think pre-COVID, we very easily would have gotten a 30-year amortization and possibly an 80% loan to value, or at least a 75, and we would have had a small sliver of recourse, and I think rates. I'll get into rates in a second, but we ended up at 25 years on that one with a 75% loan to value. So that right there is it's a little hit to the cash flow, and it does impair a little bit of what we're trying to get accomplished at the property to really make that property something special and use that extra cash flow to put back into the property. But in essence, though, we did find a local lender. I did have to cast a much wider net because I thought I could still get the 30-year amortization on that, but it was challenging. On rates, I mean, Tom just mentioned a sub 2.5% rate. You're welcome very much for that. So it's, but I mean, that was done with an interest rate swap. Well, on smaller properties like this, we can't hedge the interest rate with a swap. So we're looking at portfolio lenders. Portfolio lenders right now are around 3.25 to maybe 3.75 for 5 to 10 year fixed rates. When when we, like yesterday, actually, we closed and locked a swap. We were at 279. And so we're able to still get these rates in the twos. But on this particular deal, I think we're at 3.3 for 10 years, if I'm not mistaken. So rates, just to hit on that for a moment, I mean, the 10-year treasuries collapsed, the LIBORs come way down. I mean, all of your indicators are way down. However, when you think about banks lending money, their biggest cost of funds is their deposit rate. So before COVID, they were paying you 0.03% on your savings account. During COVID, they're paying you 0.03% on your savings account. So their cost of funds on a big portion of their balance sheet hasn't changed. So they can't just, because the 10-year treasury came down, 150 basis points, they can't just drop their rate down to, 2% on their balance sheet. So we are kind of, in my opinion, we're at kind of a floor for portfolio rates in that lower 3%, lower to mid 3%. I don't really see it going too much further down. Does that kind of answer your questions,
Also when you
Craig?
talk about the 12 unit, I know it's happened on a property that we were closing on just prior to the closing. A number of tenants weren't paying their full rent. I'm sure Tom can relate to this. Some just can't, and some just need some assistance for 3 or 4 months. And the bank wanted some money set aside to cover that in the event those tenants either didn't make it or didn't get back to paying their full rent. Are you seeing that amongst the banks today, whether it's a 12 unit, which is a little smaller, but any of the larger deals? Are the banks asking for cash reserves or other things to hedge the bet on a number of the tenants given the economy?
Yeah, I mean, on that particular deal, they're not asking for it. That particular deal, the collections have been very, very favorable. One of the 12 units, there was a portion of the rent last month that wasn't paid, or just maybe like 70% of their rent wasn't paid. So I mean, it's a strong building, and you have strong sponsorship and good borrower structure. So you're putting 25% down. So in that particular situation, they're not asking for a reserve. But there are situations where I've definitely seen where they are asking for a reserve. If you have a higher leverage property that's maybe a little higher risk, that has a higher component of retail or so on, a bank may ask for a reserve just to get through this first year. So maybe after you provide those tax returns after the first year, you can get those released. Go ahead, Tom.
Yeah, Trav. I mean, we just did a 40 unit. We just refinanced a 40 unit that we've had, I don't know, for quite a while, and
Right.
Maybe we've owned it for 15, 20 years. We did a 40 unit. They wanted $2,500 a unit set aside. So to your point, Craig, that was $100,000 that they want us just to keep in their bank beyond the deposit relationship that we committed ourselves to with them. This is $100,000 in the bank, and I do think it's just worry money because the property's in great shape. We've owned it forever, and the banker, who's become a good friend of ours, said, look, we just, when we see, just as you said, Trav, when we see your tax returns or we see your numbers at year end, and we see that everything went as fine as we think it is, then you can take the money out of this reserve account. But at $2,500 a unit, that was pretty substantial.
Yeah, no, I've seen the same on larger product retail. I've seen that coming down the pike as well. Let's talk about interest rates a little bit. Let me move to Paul. Paul, you're somewhat underwriting behind the bank. Rates are low. Have rates come down in your side of the world at all? And also, I'd say for both Travis and Paul, are you seeing more of a commitment needed, recourse versus non-recourse? How is that coming into play?
Sure, I'll start off and then Trav can jump in. So in my world, it's full recourse. So there's no question on that piece, at least on the SBA side. Banks can limit it a little bit if they want, but most owner users are willing to offer recourse because it's their business, it's their livelihood. It's not an investment that's, a secondary product to their regular income. As far as rates go, I could feel all the bankers on the call just kind of cringe when Trav and Tom talked about 2.5%, and then when Trav said between 3.25% and 3.75 for 10 years, I could also feel them kind of twitch a little on that. I just note that Tom's obviously a much stronger borrower than you or I that would go out and just buy a 12 unit ourselves. So keep that in mind. Rates definitely brought down in my world. We were floating around 5% last year when rates ticked up, and like I said, we're down below 3 now. Our rates are just set once a month because it's a government-backed security that is sold on the secondary market, and that 3% is all in. That includes fees. It's more like an APR than a rate, so it's very competitive for sure. Trav, do you want to jump in on that? Oh, sorry.
Well, is the 40% that the primary bank will have, will they also be that under that 3%? Because the bank rate in an SBA loan can be different than the SBA loan portion. Is that correct?
Yeah. So the bank does the first 50% and they set their own terms, which is another reason why the bank likes the 504, because they're not limited at all in how they set their terms. Sometimes back in the day when prime was 3.25 the last time around, people would sometimes leave the bank portion variable and then have our portion fixed for the 20 or 25 years. And that way it would give them a very nice low blended rate.
And Travis, your comments on rates?
Yeah, rate in recourse as well. So, if there's a significant construction component, banks primarily always want full recourse. When you have a stabilized property and a strong sponsorship, banks will often reduce that recourse, maybe once it's stabilized, or if it is stabilized, have a smaller slice. So maybe the borrower pays, if it's a 75% deal, maybe the borrower's signing a 25 or 50% recourse. That was pre-COVID. And with smaller borrowers, and I would say majority of the borrowers, you're typically full recourse on 75% type deals. As your loan to value drops, though, that recourse will burn off, and then often, like yesterday, the deal we did, it was a 60% loan to value, and that was non-recourse. A lot of banks during COVID, though, are requiring full recourse, and I wish I knew this for certain, but I believe that recourse also impacts the capital that they have to post as part of their capital requirements. So if they have a full recourse loan, they may not have to post as much capital. So right now, a lot of banks are taking the stand that we need 100% recourse on everything. So I have seen that quite a bit, regardless of borrower strength.
To Paul's point about the strength of us as a borrower, I do think, Paul, you're right. I mean, I think part of the reason the rates are lower is because, with a number of the properties we recently refinanced, the loan to value is 50 or 60%. We've owned it for 10 to 20 years. The property's in great shape because we've been manicuring it for that long. And so I do think, to your point, while all my banker friends may be cringing, I do think, as you said, it's sort of the strength of borrower, strength of asset that move the rate to that level. I did want to say, a shout out to because I was telling Trav and Craig and Dave and Paul that we are doing business now with 10 banks. And from my perspective, I like that diversification. I like the number of relationships that we have. One of the wonderful things about that is that all of those banks are local. I mean, even we could say Eastern's Mass, but Muscoma's New Hampshire, but they're all local. When I started this 26 years ago, so like say 20 years ago, 15 years ago, the main people that would lend on apartment buildings was Fannie Mae. And I was having to go to DC and to Boston and New York to get these Fannie Mae lenders. And this is a shout out to all these great bankers that I'm doing business with. And about 10 years ago, they all said, we're going to compete with Fannie Mae and we're going to beat them out. And they have. And they've been doing it for 10 years. And I'll tell you, it's a hell of a lot better. It's a hell of a lot more fun doing business with people that work down the street, that can go after work and have a beer with, than having someone in Buffalo, New York call me and ask me for, weird, silly numbers throughout the year. So shout out to all the great banks that we have in this area. So
let's move on to
That's
property type and see if there's any differences there. And David, as you're doing your appraisal, is there much differential these days, whether you're doing residential or commercial, whether the asset type has a lot of retail or restaurants, whether the tenants are local or national? Anything new as you're reviewing a property?
The residential's a totally different dynamic taking place there. When COVID kind of kicked in March, there was a precipitous drop in supply, as we also saw the same in demand. Everybody was like stepping back. And now, a month later, the supply is still very low. And for those people that are passed through this unemployment process and made it through and haven't lost their livelihood, they still have the strength of borrowing at very low rates, and they're out and shopping. So what I'm seeing on the residential market are properties that are being quickly absorbed. Days on market are very low, and it's a reflection of supply. And the other thing we've heard quite a bit of is a lot of out-of-state buyers coming and picking up property in Maine as a way of getting out of Dodge. And it's a real dynamic.
You're talking houses?
Yeah.
You're talking houses and condos, or you're talking commercial properties, or all of it?
Mostly residential from that perspective. We're not seeing much buying activity on the commercial side, but again, that's relative to the supply as well. There's not a lot of opportunity there. So those are the data points that we're kind of missing, but those are the details I'm picking up in the market when I'm talking to people.
And you folks work all over the state. I'm not sure if you work outside of Maine. Any regional differences from York County to Cumberland, up to Androscoggin, up further north? Or is it all fairly active, or as active as it was pre-COVID?
Well, the stats that the MLS came out with last week for April showed that the biggest changes are taking place in northern Maine. But for the most part, the percentages are not that far off from one another on a residential perspective. We don't go far afield in residential. We stay in Greater Portland. And then commercial, we've been known to go outside of York and Cumberland County, depending on the property type and the asset involved. But again, mostly we're in Greater Portland, so our knowledge is very localized. But we're seeing everything that you folks are talking about. That the retail industry is being impacted. I've seen and heard of stories in the office market the same way, whether it's large credit tenants that are looking for some forgiveness, or the small incubator user that says, well, I'm going to go work from home. And just yesterday, someone told me from a residential perspective, a 3-unit property in Portland that was recently listed, and the buyer was going in at 8% over list price, making an offer. So,
Yeah,
that's an aggressive market, but it reflects that supply and demand dynamic.
Yeah, I think that part of the market is still very active. Let's move on a little bit to communication. It was something else that Tom had touched on in his opening remarks. How has communication changed over the last 8 weeks? I would say Tom and Travis, both with your bankers and partners, but also Tom amongst your various tenants. You mentioned you have, I think you said 1,000 tenants or more. Are you communicating with them more? whether it's your residential tenant, your restaurant tenant. The restaurant folks in at least the Portland area have been pushed back another 30
Yeah.
days. How has communication changed for you?
So it's interesting. Thanks, Craig. Great question. It's been interesting with our residential tenants, which is the bulk of our portfolio. Again, we have a group, Jen Monroe is our COO, and we use Longfellow Communications, Jessica James, and the two of them have been just daily getting together and putting out communications to our staff. If you're going to go into a building, what should you be wearing? What should you be wiping down? If you're going to go into an apartment, how do you notify the tenant? When you go in, what are you wearing? I mean, it's been none of this we thought about, none of this we did before. So we were trying to pick up industry standards, so anyway, we came up with a plan. We communicate with our employees, we communicate with our tenants. At one point, for example, there was a question: if we own a 64 unit apartment building, and a friend of a tenant or a tenant came down with COVID, do you post the building? Do you let everyone know that someone in the building had COVID and worry about creating fear, or do you do nothing but do all the right things? Just wipe things down, because that's all you really can do anyways. But those are the kind of things that we had to think about, that we haven't faced before. In any event, of course, we communicate everything. What we came to is communicate everything all the time. Let your tenants know everything that's going on in your building. If someone got COVID, let your tenants know. So that's the residential tenants. And I should say, as I told you, we had 2 construction projects shut down, so we had to communicate to the vendors. And there was a concern there too. If I tell the HVAC guy that one of the carpenters had COVID, is the HVAC guy, is he going to show up the next day? Right? So now you're saying, well, should we tell him or not? And again, at the end of the day, we said, just tell everybody everything, and tell everybody what you're doing, how you're going to wipe it down, that you're going to close it down for 2 days and bring in the cleaners. And then when you come back, this is how we're going to do it. So that if you're the HVAC guy, you can go home and you can tell your wife or your mom and dad that might live the house over, yes, there was COVID on site, but this is how we're handling it. So that's what we decided to do. We just said, tell everybody everything we're doing and be open book. And so that's where we've landed. Really, that's Jen and Jess who are doing that. As for the last piece, as for the commercial tenants, it's interesting. One of the interesting things about this pandemic is that it has brought out everybody's all different kinds of personality traits. I remember when I started business, I was 29, and every time I went to a closing, I'm buying from some guy in his late 60s, and he just wanted to stick it to me. Or people would argue over $100 or $1,000 at a closing. I'm like, really? And it just brings out, sometimes, Craig, I know you guys have seen this, sometimes it's just, these closings just bring out the worst in people. Well, I'll tell you, so has the pandemic. But you know what? It only brought out the worst in people for a little bit, right? You get your commercial tenants saying, I'm not paying rent for the whole rest of the year. And they're serious, they're mean, and they've got a letter from their lawyer backing it up. So that was, for a couple of people, that was the starting point. Just starting like aggressive. But then you're saying, look, okay, they've got kids at home. They had to shut down their business. What are we all really after? They don't want to lose their space. They know I got to pay the mortgage. They know I got to pay real estate taxes. So now we sort of work towards, what can we do together? Can you pay me 50%? Can you pay me 60%? Yes, I can. For those that you can pay 100, pay 100 now. If you can't pay 100 next month, what can you pay? And as I said, it's forbearance today. It's not forgiveness. It's forbearance. And we'll just play this out as long as COVID goes on. We'll figure out what, can people at the end of the year, can they pay what they didn't, or can't they? We'll work it out. And so the beautiful thing about the pandemic is that,
Tom, how many of your tenants do you think are struggling? Tom, how many of your tenants do you feel are struggling to pay? Are the vast majority paying 100% of their rent and seem fine? What does that number look like? And I'd add to that, what sort of resources or services are you seeing that whether it's a tenant or a restaurant, are they turning to help them get through this period?
Yes, so residential, people seem to be doing fine. I think I talked to Jen this morning. She said 40 people applied for that $500 one-time $500 month that from the state of Maine was providing for rental assistance. But we have about 2,000 tenants, so that is a very, very small percentage. So I say residential tenants are fine. They're paying. I think most of them are employed. We think a small portion of our tenants are unemployed, but they're receiving benefits. So I think we're okay on the residential side. The commercial side, that's really where we're working together. I mean, I know I get a little chatty here, but for example, look at Wilson County Barbecue. For example, they're the RERA guys, right? So I don't know if you know, but I developed the RERA and Flatbread War, 20 plus years ago. So I stayed friends with the RERA guys. And when I did 82 Hanover down at near Bayside Bowl, they said, hey, we'd like to open a barbecue place. So, okay, so they opened the barbecue place. The day before St. Patrick, think about it, they own 9 Irish pubs. The day before St. Patrick's Day, they've got all their kegs entirely full. Their bar is stocked with all the best Irish whiskeys and bourbons. All their vendors have plowed all the food in. Every restaurant is full. The day before St. Patrick's Day, the biggest day, and in some cases the biggest week for RERA, all 9 of their Irish pubs, they had to shut down. I mean, talk about a hit. And Wilson County Barbecue, they just opened and then they had to shut down. So how can you, I know I still have to pay my mortgage, but I'm incredibly sympathetic with those guys. So we are working out, okay, can you pay your triple nets? How can we give you more outside space so that when we can open up, you have more space to serve. And so of course we're working with people, but it's not easy. It's a lot of work. It's constant conversation. And like I say, but the pandemic in some ways has brought the best. It started bringing out some of the worst, and over time, it's really brought out the best and some of the best in people. So there you have it.
And how's that communication gone with?
Can I jump in?
No, that's great. How's that communication gone with bankers and your lenders and your partners? Are they checking in with you more to see how your tenants are going, or is it or not?
No, it's so funny. They sort of, I think because we have such a good reputation, we're a very strong borrower. There's almost this sort of like sheepish call, like, so how's it going? And the answer is it's going fine. I will tell you, this is kind of interesting though, and Trav, you can speak to this. The forbearance part, right? That some banks are saying, look, if you've got you're having trouble with cash flow because certain tenants aren't paying. We had one small property, 65% commercial. Both tenants said, either I'm not going to pay or I can't pay. And so we went to the bank. We said, geez, we'd like to work on forbearance. And the bank, it was TD. They're great. I've been doing business with them for 25 years. They lent to me when they probably shouldn't have. And shout out to Bill Shad and Colin March, great guys. So they said, look, we'll forbear for 3 months. Okay, fine. And but what's interesting is that some of the other bankers, and Trav, you can speak to this, when we're going for refinancings or we're going for financings, the other bankers are saying, so has Watson sought forbearance anywhere? And so what I've sort of realized is that, okay, you really want to be careful with this forbearance because there's sort of this there might be some reputational risk. I don't know, Trav, you want to speak to that? It's kind of interesting.
Yeah, no, it is interesting. And, it's kind of like after the 08-09 issues, that financial crisis that we had, the banks were like, so how did these borrowers, how did they deal with this? And today it's the same thing. It's like, how is this borrower dealing with his banking relationships? Because it's important for them to know what they're getting themselves into. So yeah, definitely, I would recommend being really careful with that and taking it when truly appropriate, because they're absolutely asking. Every banker is asking that question.
Can I jump in real quick, Craig?
Yeah, because I wanted to turn to you and just see what your thoughts on that are, and also how many of your loans are people coming to you folks on the SBA cycle looking for some assistance?
Yeah, so the forbearance piece I want to hit on real quick first. So that is a real thing to consider. Like Trav and Tom both said, we do have a refinance program through the 504, but part of that program is that you have to be current on your payments for the last 12 months, and the SBA considers forbearance not current. So that's really important because a lot of people, when we come out of this, are going to be looking to refinance their property. The SBA 504 is a great option because the bank's at 50% loan to value. You know, maybe the banks don't want to give them more money, but we can work with the bank and give them more money through the program. But if you've been on forbearance at all over that time period, right now at least, the SBA is working on a change, but right now at least the answer is no. It's just not going to happen.
Interesting.
And then what was your second part? Sorry.
Just wondering if what defaults look like on loans these days. Have they started to hit yet, or?
Yeah, so that's another really interesting piece is that when this all came out, part of the CARES Act was that the government is paying 6 months of payments on all 504 loans across the country. So essentially, every borrower that has a 504, it's not the bank portion, keep in mind, it's just that 40% behind the bank. The federal government's making those payments. It's not a deferment, as Tom talks about. They're actually making that payment for them.
Wow, interesting.
Wow.
Yeah, which is crazy.
Yeah.
I think, Trav, I think we got to call our bankers.
These are operating companies, though, Tom.
Little different.
Yeah.
You're making my job harder here.
We're going to begin to wrap things up here. I wanted to give each of you a moment to just give us a little insight to what you think the future holds. When do we get back to normal? Is this our new normal? Are rates going to stay low? Tom, or I guess Travis, why don't we start with you? What do you think the future holds for us in financing?
Sure. Yeah. No. It is hard to tell because things are always shifting every day with banks. But I think that they're going to cautiously continue to lend. I think it's really important. I mean, the lenders that we have here, and I echo Tom's comment on dealing with local lenders. That's primarily well over 90% of what we do is local lenders, because that key relationship is so important, and for them to continue to help support our economy is crucial, and they're doing a great job with that, and they're working really hard. So I do commend them for that. And so I do think that we're going to continue to move forward and continue to find good lending structures within the community. And this bank over here is going to maybe step back a little. This one's going to step forward, and we're going to continue to be able to find good structures out there. So I do want to thank them. And Tom, just closing, thanks for the partnership and the kind words. I do appreciate that. And MEREDA, I mean, what you guys do is crucial. So thanks for everything you guys do.
Those are kind words. And Paul, how about SBA? What's the future look like for SBA?
Yeah, so I'm cautiously optimistic. The next big problem in the banking side is going to be the PPP forgiveness program. I think that's going to make the bankers work really hard, and I'm hoping that goes well, but I'm not super optimistic. Once we do get through that, I think things will be a new norm. But as Dave mentioned, the owner users' values of properties are not being hit as hard as investment. And I think that that's a great thing to keep in mind. And with super low rates, it's time to go out and find something to buy.
So David, with that, we hear Tom is buying properties. Paul says that owner users are buying properties. How do you see the health of the market going forward?
I think it's going to take a little while to shake out. We've started 2 months ago trying to deal with this the best we can. And as an example, initially, we thought the unemployment impact was going to have a harder hit on the apartment sector and rent concessions, things of that nature. Tom's indication that his portfolio has a very low rate of loss. And we spoke to a management company yesterday in Portland that, takes care of 700 units. They only have 20 units that they can't pay part of the rent on. So those are very low numbers. So what we're seeing is it's going to take a while to figure out exactly where the impacts are taking place. And we're kind of early in the stages, and we're just going to keep changing as the process changes itself. But I do believe that it's shorter term, not longer term.
And Tom, do you remain bullish?
Yeah,
Are you looking for more acquisitions, and you got to keep
Oh,
Trav busy over the next year?
A couple of things. Dave is spot on. I think it's going to take a while. But everyone that's on this stream, I want you to know this. I feel very strongly about this, and I'm going to say right to the camera: this is not the new normal. This is not the new normal. I was thinking about Craig. This is my fourth time. If you're of a certain age, I'm 57. This is the fourth time I've been through an economic bust. Right? 89, I had a painting and sheetrock business in Boston, Massachusetts, completely bust. I ran to business school. Right. And then there was the bubble in 2000. Then there was 2009, 2010. It was just, I think vacancies went up to 11%. We figured it out. This is not the new normal. I think, like Dave said, it's just going to take a while, but we'll all be back. I mean, I think people are so eager to get to work and get busy. Real quick story. I got a maintenance guy. He comes in and, I said, Jason, you okay working? Because he's, I've got a number of employees who are, a little worried about going to work. I said, Jason, you okay working? He says, oh man, work is a vacation compared to being home. And I said, okay, that to me, I said, that to me is an indicator of where people in America want to be. They want to come and get to work, be part of a team, be part of an accomplishment. It's coming. Like Dave says, not sure how long it's going to be, but it's coming. That's my 2 cents.
Well, it's a great 2 cents. Well, let me wrap this up by saying thank you all. I think this has been a really interesting conversation. A lot of really valuable information has been shared. So thank you all. And thank you to all the MEREDA folks out there watching us. We appreciate it. And we wish you well and hope to see you all soon. Have a good day.
Thanks, everyone. Have a good one.
Thank you.